Hi, everyone. As Jonathan introduced us, my name is Yuna. I'm an enforcement attorney at the Securities and Exchange Commission, or SEC. We're so glad that you can join us. Thank you for taking the time. Thank you to the San Francisco Public Library for hosting us, and of course, especially to Jonathan for organizing. As you can see, the presentation we have for you today is Building Wealth Through Saving and Investing. Today, we'll be talking about this topic as well as hitting on some tips for avoiding investment fraud. Before we dive into the presentation, I'm just going to provide a disclosure that we always provide before speaking with audiences. This presentation is not a statement of official SEC policy, a legal interpretation, or legal advice, or investment advice. While we are speaking in our official capacities as staff from the SEC's San Francisco Regional Office, the views we express today do not necessarily reflect the views of the Commission, the commissioners, or other members of the staff. The SEC, as you may know, is a federal agency. We have a three-part mission to facilitate capital formation, ensure that markets are fair and orderly, and to protect investors. And I am very fortunate as an enforcement attorney to get to take part in this mission by conducting investigations into securities fraud and other violations of securities laws. Next slide. So what you see here is a snippet of a web page. You'll see at the top left corner the SEC's seal. The top of the page here, you'll see investor.gov. This is the SEC's public-facing web page with free and unbiased tools and resources on saving and investing. This page, can't reiterate enough, is worth jotting down, bookmarking, sharing with your friends and family and your neighbors. It's an incredible website with great tools. While today may not be the day you're primarily focused on your long-term finances, tomorrow, a week, a month, a year from now, this page might be the one that is going to help you become a smarter investor. It's more has incredible financial planning tools, including calculators for retirement, compound interest and saving, Social Security retirement. There are also investor quizzes to test your knowledge, information sheets that you can reference to learn more about different types of investment scams, and search tools like check out your investment professional search tool, where you can look up somebody who puts themselves out to be a broker or an investment advisor, and you could look up their disciplinary history. And this is just scratching the surface of the materials you'll be able to reference through investor.gov. So highly recommend that you save this for future reference. Next slide. A roadmap to building wealth through saving and investing. Seems very basic, but very important always to revisit. Some people build wealth through successful businesses or having extraordinary talents or just honestly great luck. But for the great majority of us, the path to wealth is most often through home ownership and long-term investing and saving. We won't talk today much about home buying, since that often involves timing, judgment, and expertise outside of our wheelhouse. But we're going to aim to give you a roadmap for building wealth through saving and investing. And it starts with being smart with your debt and having an emergency fund. And once you have those two steps down, you put in the infrastructure to make regular, even sometimes automated contributions to an investment, and you keep doing that for a long time. Next slide. So wealth mindset, needs versus wants. A pretty basic graphic here. We see on the need side, water, food, shelter. On the want side, arguably a venti pumpkin spice latte, a DoorDash delivery, and luxury apartment with no roommates. This is just a reminder. It's helpful to be in the mindset to get into the mindset to beginning to build wealth. The first step is being able to distinguish between wants and needs. There are some fairly easy ones. Obviously, we need air, but we probably don't need a $100 oxygen bar treatment. Likewise, we need shelter, but we don't need the fanciest apartment with no roommates. I mean, these are pretty basic, but as you know, it can get a little tougher to distinguish at times. For example, do we need the latest smartphone? Do we need streaming services or subscriptions? And if so, how many? Do we need a car? Always helpful to kind of get back to the basics and think about wants versus needs. Next slide. So here's an example, continuation of the theme of wealth mindset, leaving room to save and invest. So you got two choices here. A great ride for $50,000, one that will impress people, but that will give you a car payment of $800 to $1,000 per month, leaving you with savings and investing of approximately $0 versus a decent ride that will allow you to include future goals. So maybe the 25K car that serves its function, that requires a $373 per month payment. And then what can you do with the rest? You could put $100 per month per saving, $300 per month into a 401k retirement account that's accessible to you, and then leave some extra spending for $66 a month that wouldn't dip you into the red. Next slide. I'm not sure if this reference is landing with folks in the audience. Think about your future self. I give myself this pep talk all the time. It seems a little silly, but you know, someday there will be a version of you who's that's going to want to have certain resources at your fingertips. Think about the person you want to be tomorrow and the things that that future person may want and need. Encourage you to visualize that person, whether it's a month from now, 10 years from now, or 40 years from now, and make your financial decisions with your longevity in mind. I'm going to turn it over to Silvana to dive into some of the topics we introduced.
Thank you, Yuna. Next slide, please. And thank you again, all of you, everyone, for joining us. I'm going to go through a little more detail with the three kind of topic areas that Yuna mentioned to kind of the road to build wealth, which you know, includes debt, getting rid of debt. It includes savings, and then, you know, long-term investing. And investing can seem like a very complicated subject and can sometimes feel like it's beyond the reach of the ordinary person. But we're going to break it down to you in an easy to follow roadmap that anyone can follow and help you build wealth over time. Next slide. As you already mentioned, I think debt is one of the things that we should keep in mind. So step one, pay down high interest debt. And, you know, I think one of the things to keep in mind is there are sometimes, especially like credit card companies that charge very high interest rates for balances. And oftentimes, if you have a lot of money with credit card debts and you're getting, for instance, maybe you're paying an 18% APR, maybe the amount that you are paying in interest can easily exceed any return that you can make from saving or investing. And so think about, you know, what you're paying with your debt and whether you can find a way to reduce that and get rid of it as much as you can. So that doesn't mean that you should not, you know, while you're trying to pay down high interest debt, that you shouldn't be investing. There may be times and opportunities to invest, right? So for instance, if there's, you know, you work for an employer that, you know, matches your contributions to a retirement plan like a 401k, you know, it may be helpful to continue making those contributions so that you can get that money, that free money that your employer is putting on the table. You don't want to leave it on the table. You want to try to use it up. Or if there are tax breaks that you could get by investing in something like a retirement account, you want to maybe take advantage of that while you're still trying to pay down high interest debt. And And again, just always keep in mind, you know, you want to focus on paying off your balance, living within your means, and then trying to, you know, once we'll get to step 2. Next page, please. Next slide. Oh, before we get to step 2, this is just another example of, you know, what the cost of credit is, right? And same kind of idea. You have a TV that you want to buy. If you pay $1,000 in cash, you know, that's it. That's what you pay. You pay that money now. But if you end up using a credit card to pay it and you're paying the minimum of $35 until you pay it off, which may be a few years from now, 3 years from now, you end up paying $1,369. So really, when you're looking at the monthly minimum that you're paying, 15% is going to interest, $20 is going to principal, and so you're going to just pay a lot more over time. And so that's one of the things to keep in mind when you're thinking about credit card debt or any other debt and any interest that is attached to that. Next slide, please. So once you kind of deal or are trying to minimize that high interest debt, you should also think about an emergency fund. One of the things that is important is, you know, that you should have some money in case something unexpected occurs. You know, a Federal Reserve study found that nearly 4 in 10 Americans do not have enough money saved to cover an unexpected expense of $400. And that could be like a minor car repair or a cracked screen on your phone or something small. And that can then, you know, have, you know, other effects if you then have to go into debt to cover all those things. So if you can, it's really important to start putting money to, you know, a rainy fund account or just having some money saved up for that type of emergency. You know, you can set a goal like $25 a month, try to build it up, try to have 3 to 6 months of living expenses saved. So if anything would happen, like, you know, something more major, like you lose a job or there's like an illness or something, you want to have 3 to 6 months. That's kind of like the, you know, kind of the goal to make sure that you can get back on your feet. And, you know, if there are opportunities when, you know, you get a tax refund that maybe you weren't expecting, or that was like a little extra money, or someone gives you a gift of money, that those are always good opportunities to then take that money and put it into an emergency fund for the future. Next page, please. And, you know, one of the things that is helpful with a savings account or you know, a checking account is that, you know, you can put your money into a bank or a credit union where it is insured, it's safe. So that money, you know, can be insured up to $250,000 per account. And so that's money that is going to be there. It's going to be safe should you need it in the future. And a lot of times, especially if you have a, you know, a bank account or credit union account, employers can put money directly by directly depositing money into that bank account. You can use debit cards with that account so that you don't have to, you know, spend with credit, and you can kind of figure out what you're, you know, living within your means. And sometimes, you know, you're building your credit and you can get access to other products like credit cards, you know, car loans and mortgages. And so again, it's a good thing to keep in mind and to try to have. One thing to keep in mind, as it says there in the bottom, is that while it's good to have an emergency fund and it's good to have that money safely protected, it's not going to grow much, right, in the bank account. And so that, I think, will take us to the next slide, please. Here you can, one of the reasons why it's going to be costly in the long run, or it's not going to be as you know, helpful to just have money in a bank account, is because you have inflation. And so here you can see how inflation affects something like the price of a truck. In 2000, you can have this new Ford F-150 that costs $15,000 and a little over $15,000. In 2025, that same truck, I mean, different model, of course, I mean, you know, it's newer, it's new in 2025, but a new car of the same style ends up costing over $38,000, right? And so inflation has an effect. And so keep that in mind, because, you know, when you have the money in a savings account or a checking account, it's growing very, very slowly, and inflation often grows faster than that. Next slide, please. And so that takes us to step 3. You know, once you have your high debt paid down, high interest rate debt paid down, and once you have an emergency fund and you have extra money, or you're thinking about kind of this, way to, take advantage of certain benefits like a 401k that gets matched by an employer or tax benefits, thinking about investing for the long term is a good way to build that wealth. And so one of the things that is helpful is to have regular investments, and the longer you have them, the greater the wealth building will be. And so one of the things that we tell folks is, as soon as you get your first job, you should try to find a way to, get into this long-term investing and keep it going for your entire career, because it will have a bigger effect. And one of the things also to keep in mind is, the stock market will go up and down. It's never constant, right? It has its down periods of something like, 2020 will happen with the pandemic, and, the stock market goes down, but then it goes up again. And so one of the things that is important is to, try to keep investing regardless of, whether the market is going up or down, and you're doing kind of this long-term investing. And so you shouldn't be thinking about, kind of timing the market, but rather just thinking about this as a long-term strategy. And remember, there are like no shortcuts or overnight paths to success. Like a lot of what we're going to be talking about is really this long-term planning. Next slide, please. And one of the reasons why investments grow, and it's helpful to kind of be consistent and do this long-term, is because the investments grow through compounding. So you have different types of investments like stocks, bonds, funds like mutual funds or ETFs. And as those, that money in that account, let's say you have stocks, maybe there are dividends and that can be reinvested. And now you have the stocks plus the dividends that are reinvested, and now that whole thing keeps growing. And so it just kind of starts to snowball, like you start getting kind of growth on the growth. And so the longer you have that, the bigger that compounding, that profit can be over time. Bonds, I don't know if you all are familiar, but bonds are another way to invest. And those are usually when you loan your money to the government or a company for a period of time. And with that, you usually earn interest, and it's paid usually like twice a year. And then at the end of the period, the bond period, you'll get your money back. And then you've also earned these interest. And, there are certain benefits to certain types of bonds. Like you can have municipal bonds that are kind of local, you can have federal ones, and then you can have the private, company ones as well. And mutual funds, and the funds there at the bottom that you see, can be things like mutual funds or ETFs. Often you'll have those type of funds in like a 401k, one of these, or another retirement account. And one of the things with funds is that they tend to be diversified. They tend to not just be, focused on one industry or one stock or one sector. It tends to have like a multiple sectors and industries or stocks, so that it can overall, weather any kind of change in the stock market. It's a little more balanced. And funds as well will have dividends and other earnings that can be reinvested and can help your investment grow. Next slide, please. Here, I think you can start seeing just how the compounding works. Let's say you have, you're putting $100 per month into the bank, and you're getting 1% interest return on it. You can see that over kind of this 40 period time, you get to 58,000. So you don't make a lot of money putting those $100 per month in a bank account that gives you 1% interest. If you instead put it into something where you get a 7% return, you can see how that money grows. And then because what the profits or what you're earning on it gets to be part of that amount that gets to grow more and more, you have this snowball effect, you have this compounding effect. And so over 40 years, if you're getting a 7% return, you end up with $241,000 instead of $58,000. So that shows you the difference in, putting it in something that, only gives you 1% interest, which tend to be something like bank accounts, like savings accounts, versus trying to do something that's more like an investment, like, what we've talked about with, these mutual funds and stocks. And so again, compounding can have a big effect over the long period. Next slide, please. And here we can just see this is a graph that shows the Standard & Poor 500 over the past 30 years. And this is an index that tracks the largest 500 public companies in the US. And you can see here, as we mentioned a little earlier, like the stock market will go up and down. It's not very, linear. Like it'll have different, things will happen that will affect it. And, sometimes you'll have a very big dip and other times you'll have a lot of growth. And so again, it's hard to time the market because you never know where you're going to end up. But historically, the performance of stocks has trended positive. And so in fact, stocks have returned an average of 7 to 10% per year, going back to the stock market crash of 1929. And so again, overall, you tend to see this kind of average of 7 to 10% per year growth, even though any one year can have a dip or larger growth depending on what is happening in the economy and the country. So again, good to think about investing as a long-term strategy. Next slide, please. And here, just again, another graphic showing you the power of starting early. If you want to reach $500,000 by the time you are 65, how much do you need to invest per month to reach that? And you can see that if you start at age 18, it's $127 per month. Whereas if you wait until you're age 55, you have to put a lot more through, and this is assuming a 7% rate of return. So it makes a difference if you can start early and be consistent with your investing. Next slide, please. Of course, there's always the question of what should you invest in. The SEC, we cannot recommend any specific investments, but there are certain things that you should think about as you're thinking about, how to build, a good investment portfolio, what good building blocks you should have. It's always, if you have already access to different products or different services, for instance, like if you work for an employer that matches any contributions to a retirement plan, that is like free money that the company is giving you that is helpful to take advantage of. Because if you put maybe $10,000 a year into your retirement account, maybe a company matches that 10,000 and now you have 20,000 that can grow. And if you keep doing that over many years, that again, the compounding is going to help it grow even more. And so if you have those type of opportunities, it's important to see if you can take advantage of them. The same thing, like sometimes people will take advantage of tax breaks. Like if they're putting money into a retirement account where you can do it pre-tax, maybe you don't have to then pay the tax at the time, and you can just put it in this account that will grow, and then it gets taxed when you retire and are taking the money out. So keep in mind those type of things. Also keep in mind diversification, like I mentioned earlier, and we'll touch on this a little bit more. The stock market may have ups and downs. One company may, have a high price one day, lower the next. It's hard to time it, and the more diversified your portfolio is, your types of investments are, the more balanced it can be, and you may not take a hit when, something happens to one company or one industry, and you can kind of weather that a little better. And overall, hope the trend of the stock market again tends to be that it is positive over the long term. And just keep in mind also fees. There are fees that you end up paying when you, access these investment vehicles. And so just keep in mind what the fees are and make sure that, you're comparing and not just, make sure you're looking at the fees and what it's going to cost you to invest in certain products or with certain companies. Next slide, please. And so here, you can just see, again, just, how people kind of think about their own investing. A lot of times people start with 401ks, like retirement plans, especially if you have employers matching that. Again, employer match is like free money that's going into this account, and it's helpful to take advantage of that if you have access to that. A lot of times people after that will also contribute to individual retirement accounts, IRAs. And that can sometimes be like a benefit because of taxes. If you were paying lower taxes because you're putting that money pre-tax into this account to grow. And so just these are things that people will do to invest in this long-term strategy. And if you have access to that, you should think about that and think about how to take advantage of any opportunities that you have, especially things like employer matches. Next slide, please. Here, just, we were mentioning the retirement accounts, with individual retirement accounts, there are traditional ones and then there are Roth. You may have heard just that regular IRA and then a Roth IRA. And there are advantages to both, they have different attributes. With the traditional one, money goes in before you pay taxes. So at the time, that money is not taxed, but it is taxed when it gets withdrawn. Roth IRAs, the money goes in after you pay your taxes once you earn that money, but it's tax-free when you withdraw it. And, there are, rules and regulations about who can access, a Roth, and there are certain limits, but, you should think about, whether you have access to that and whether it makes sense for you to, use any of these strategies. Next slide, please. And here we're touching back on the diversification. You want to try to spread your investments among different companies, sectors, and even asset classes. Like, it's helpful to not have all your eggs in one basket. If you just invest in, let's say, technology companies or just pharmaceutical companies, but then something happens to the industry and the stocks go down, that may really affect you. And so in order to limit losses or even to help your investments grow overall, it is helpful to think about diversifying and just being part of different types of investments, different industries, different types of companies, so that you can, make the most of the different types of investments available. Next slide, please. And here it just shows you, what can happen with a stock, like a single stock, in one day, right? So here you can see that, maybe if you had just invested in NVIDIA, in this day it was red, it went down, the stock price went down, so you would have lost. But Apple, went up. And so each individual stock can have, it can go up and down each day. When you invest in like an index fund, invest in like mutual funds, like these funds that have a lot of different companies, industries, types of investments in them, it can help overall, lessen the losses you may suffer, because they will have in their portfolio companies stock that goes up as well as the ones that go down. And so overall, you're not just going down as much as if you had just invested with one of the companies that went down. So that's one of the benefits of diversifying. Next slide, please. And this is just to show you, there was a study by the Library of Congress that showed that active traders, people who are trading a lot, like buying and then selling quickly, that those type of traders tend to underperform the market. And often they will pay higher taxes than people who are long-term investors, who are like buying and holding the investment for a long time. And again, there may be tax breaks when you, invest in like long-term investments, like the IRA, where you may be able to pre-tax put that money in to have it grow. Or if you have an employer match and these like long-term retirement accounts that you can take advantage of, that you wouldn't be able to if you were just doing this day trading, like kind of active trading. And so just keep that in mind. I know that it can be, nowadays it's easier to, I think, invest with, different applications and it's easier to, go online and buy and sell quickly, but just keep in mind that there was a Library of Congress study that showed that it actually, these type of traders tend to underperform the market over the long term. Next slide, please. And similar to what we have been mentioning, timing the market. knowing which stock will rise in value and which will, not, like predicting all of that is very difficult. And here's just an example of, maybe 1990, you could have had the opportunity to either invest in Sears, like a big box retailer that had a respected national reputation, or you could have invested in a small Seattle startup that was looking to sell books on the internet. Like, what would have you chosen? Like, would you have known that, this small Seattle startup was going to become Amazon and like really, like a big company with a market capitalization over $1 trillion. It's hard to know, right? It's hard to know what will happen. So trying to predict what stock will be the winner and, trying to time the market is always challenging. Next slide. Here's another example. Back in 2002, there were different, cell phone companies. One of them, here you can see the first example, the company that made the most popular cell phone in 2002 was Nokia, the company that made a cell phone that allowed users to send emails. That was RIM, Research in Motion, with the popular BlackBerry back in the day. For those of us who used to have those back when they came out and were all the rage. And then there was this other company that made personal computers and MP3 players, right? And, if you had invested it then, which one would you have chosen, knowing that, telephones were big and cell phones were going to be big? Not sure if everyone would have chosen Apple at the time, right? If you thought that it was really about cell phones and not this company that was doing something that seemed separate from cell phones. So again, difficult to predict what's going to happen in the future, to time the market, to figure out what the winning stock is. Next slide. And going back to the same theme, diversified investments like index funds and ETFs, like that's already diversified. It can give you the benefit of this long-term stock growth without having to predict who will win. And so again, when you buy or when you invest in these like mutual funds, these ETFs with products in like 401ks, a lot of these are mutual fund. These are funds that have different types of investment. Different types of investment assets. So they may have like stock, they may have bonds and other things. And so they're diversified. They help you kind of balance that out. So it's, helpful to look at those to kind of think when you're trying to diversify, like that's a good way to do it. Next slide. And this is 401k millionaires. So this slide shows you that there are, a lot of people who have gotten to, investment accounts that have over $1 million. And these people are not, these people are people who have done it through retirement accounts. So there was a study, I think it was from Fidelity, that showed that, a large investment company alone had more than 500,000 customers with 401k accounts, these retirement accounts, where they're with balances that were over $1 million. So these people, these accounts are retirement accounts, they're long-term accounts, but a lot of people are, building wealth this way for retirement. And in the public sector, there you see the military and federal employees. There's another vehicle called the Thrift Savings Plan, which is like their retirement account, right? And in that, over 150,000 people were had accounts over $1 million, and that's people with government salaries. So people can build wealth, even in the government side, with companies that allow you to have these retirement investments. So definitely, these are part of these long-term investing strategies. It shows you how the long-term strategies work out. Next slide, please. Same theme of, it's good to have a long-term strategy, try to participate in 401ks or other retirement accounts from the beginning of your career so that you can take advantage of, compounding. You can take advantage of employer matches if they're there. Try to contribute, as often as you can, consistently, whether the stock market is up or down, and try to contribute throughout your career, so that you can really build that long-term wealth. Next slide, please. One thing to keep in mind as you're thinking about investing and the types of investment vehicles is just investment fees. There are investment fees that come up, and you want to understand what the fees are before you invest, just to see how much of the money that you're investing will actually be going towards fees and not towards the growth of your money. One of the things that we have here is like an investment tool that you can check out, which is FINRA's Fund Analyzer tool. And that's available at FINRA's website. And there you can check out and compare fees for mutual funds and ETFs. And so that's a helpful tool. Try to bookmark it, try to look for it, and try to take a look when you're thinking about investing in mutual funds or ETFs. Next slide. There are other types of investments, I think, where we've talked about, stocks, bonds, funds. There are other things like private equity, venture capital, hedge funds, commodities. A lot of these can be very complex. Fees can be higher. Some of them are limited to accredited investors, which usually there's like a definition for it. Usually it requires high net worth or income. And fewer investor protections usually are available when you have these types of investments, alternative investments. Sometimes there's less transparency, right? And sometimes liquidity is, not there, can be limited. If it's like a private company that you're investing in, maybe you're not going to be able to sell that, just like you would like a publicly traded company. So just keep that in mind when you're thinking about investing outside of kind of those three things that we mentioned earlier: stocks, bonds, and funds in general. Next slide. And now we have crypto assets. As you may have heard, things that the SEC are changing. The SEC has a crypto task force to consider, among things, the regulatory landscape for crypto assets. One of the things that one of our divisions, Corporation Finance, recently stated that meme coins are not going to be treated as securities. So things are changing in the regulatory landscape. Just keep in mind when you're considering any crypto investments, you just consider your overall portfolio. There can be volatility with crypto that you should take into consideration. There may be some risks with some crypto. So just keep that in mind as you're thinking about, your overall portfolio, your risk tolerance, your time horizon for, this investment. And, just like any other popular or buzzworthy concept, there can be, fraudsters, scam artists that use crypto to try to promote the traditional like Ponzi scheme or bogus investments. So just keep in mind that there are people who try to use something that's new and or it's like, kind of the new thing, popular thing to try to get, to defraud people. So keep that in mind and make sure you educate yourself about the investment before investing. Next slide. And same thing with just apps and online platforms. Sometimes, it's easier to invest these days, but also sometimes you may, be paying fees every time you invest, and that may be eating away at your growth, or, so just keep in mind that sometimes the gamification of some of this trading may make you try to be a more active investor. Maybe that doesn't fit along the lines of what you hope to achieve in your investing strategy. So just keep your strategy in mind when you're thinking about how you're going to be investing. Next slide. And now I'm going to turn it back to Yuna, who's going to give you some tips to avoid fraud.
Thanks, Silvana. I see that we're running out of time. We're going to zoom through this section so that we have a little bit of time for Q&A. So we wanted to include this section because an important consideration in your investing journey is, of course, to ensure that you don't fall victim to investment fraud. This is literally part of my job description. I get to investigate potential investment fraud and bring actions for investigation for potential investment fraud. Even sophisticated investors fall victim to scams each year. And so we just wanted to discuss at least some basics of investment fraud avoidance. Next slide. So take steps to avoid fraud. Once you build wealth, you want to make sure you want to protect it from scammers. If it sounds too good to be true, trust your gut. It is. Uh, be careful if you're asked to pay for an investment with gift cards, cryptocurrency, or wires overseas. Scammers love to have victims pay with untraceable and irreversible methods such as these. Unfortunately, once you send money that way, it's gone. Never be pressured to buy quickly. Never be pressured to make a quick decision. No legitimate investment requires an immediate rash decision on your part. And so that if somebody is pressuring you to do that unsolicited, that's definitely a big red flag. Always take your time to research any investment, look at unbiased resources from sources that aren't trying to sell you anything or trying to solicit your funds. And that last bullet point, we bring up investor.gov again. I mentioned earlier there is a tool. You'll see on the left side a little screenshot of this tool. It's check out your investment professional tool. You can toggle, there's a toggle down menu, so you can choose individual or entity name. You could basically check out a purported investment advisor or broker as quickly as you can Google a term or check a restaurant review on Yelp. You literally just put their name in and you're going to get a result that shows a variety of helpful background information, including whether they're actually licensed and registered. You'll also see their employment history and any other important disclosures like customer complaints or disciplinary actions. Sometimes we might, in our investigation, see friends of friends of friends be introduced to someone, so they just inherently trust that it was a good introduction. Or maybe you heard about this from somebody in your bocce ball league or at church, and you're just like, hey, this is my buddy. They're not going to give me a bad recommendation. No one's saying that they were trying to give you a bad recommendation, but it's always helpful to check, double check, always before you make an investment, everything you can, both about the potential investment professional or about the investment. Next slide. So we could really spend an entire day talking about different types of investment fraud and investment scams. Unfortunately, we're highlighting relationship investment scams as one type of investment fraud to be on the lookout for because we've been observing a rise in relationship investment scams. These have various names that you may have heard of or seen in the news. It might be referenced as a romance scam, financial grooming scam, or even a pretty unsavory term called a pig butchering scam. These are generally online scams that are long cons. They're long-term confidence scams that often start with just an unsolicited hello, text message or social media message. I don't know about you, but I get these all the time and I try to report them every day and I still get them all the time. These seem like innocent texts, but are often just a pretext to get you to respond and communicate with a scammer. They might slowly try to build trust, perhaps even a friendship, and ultimately lead to some sort of investment pitch or scam of some sort. The operators of these types of scams might be victims of human trafficking or forced into this crime. Just as a general rule of thumb, do not reply to messages from people you do not know. Next slide. So how does a relationship investment scam play out? So as I noted, it's just kind of like a long con. The scammer develops a relationship with their mark and just again starts as friendly banter, might even not talk about a financial issue at first, but eventually the scammer will introduce some bogus investment opportunity and try to get your money. And once you realize it's a scam, you might be out of the money. You'll be out of the money, excuse me, but you may not be out of the woods. The scammers may unfortunately then sell your contact information to other fraudsters who may approach you with additional bogus offers to recover your funds or get involved in other scams. Don't be polite and correct a seemingly accidental contact, just delete it. block the sender, and report it. At the bottom of this slide, you'll see another link to investor.gov. This one is /relationship scams. If you want to learn more about relationship scams, investor.gov also has information pages for all sorts of investment frauds, including some of the ones that we mentioned during the presentation today, including pre-IPO scams, Ponzi schemes, pyramid schemes. It's all there for you to reference when you have the time. Next slide. So to sum it up, summing up sort of our presentation in its entirety, not just fraud, avoiding fraud. Spend less to free up room to save and invest. Seems basic, but knowing the difference between wants and needs and delaying gratification for your future self can free up room to save and invest. Pay down high interest debt and live within your means. If we have credit card debt, we need to pay that down aggressively and make an intentional spending plan to live within our means. Get banked and set up automatic contributions to an emergency fund and long-term investments. It's helpful here to have a bank or credit union account, and once you have it, set up automatic contributions from your paycheck to go to your emergency fund or a tax-advantaged investment like a 401k and IRA. Start with your 401k and IRA and invest consistently to build wealth throughout your career. Investing is a long game. Exercise caution if promotions make investing seem easy, quick, or guaranteed. Remember that most people build wealth through investing slowly and consistently. Ignore investments that promise overnight success or guaranteed results. And just to reiterate an earlier point, compounding happens if you invest early and continue doing it consistently for a long time. You heard a bunch of examples today, but your first investment fund could start with the $50 you save by not buying expensive lattes a couple of times a month, which through compounding interest at a 7% return over a couple decades, over 30, 40 years, will lead to hundreds of thousands of dollars. So just remember, it's about investing slowly and consistently to build your wealth. Next slide. So this is just a page to encourage you to contact the SEC. The help.sec.gov is to submit investor complaints and questions. And then reporting suspected securities fraud, whether it's this is something that you could share with others in your lives who are concerned about suspected securities fraud. www.sec.gov/TCR. TCR stands for Tips, Complaints, and Referrals. And there's a form that the public can fill out to give the SEC tips or complaints about suspected fraud. Next slide. And last but not least, this is the direct contact information for the San Francisco regional office, where both Silvana and I are. So please feel free to jot it down. And
Thank you.
Thank you so much for your attention.